Okay, so for this mock exercise, we're going to take a look at budgeting. And we're going to take a look at this case called Sear Manufacturing, and we're going to actually look at how does a company budget for direct materials and direct labor. So that's essentially what we're going to do. We're going to use this example. Now, just as a general point, oftentimes the company will be required to prepare a budget, and the process, irrespective of whether they do it on an Excel or perhaps a budgeting tool that's available in the marketplace, or perhaps just using pen to paper, you'll see that the process and the concepts are the same. The building blocks of building a budget is the same. Normally, when a company sets the individual budgets, they need to start with how much revenue they plan to sell. That's extremely important because that establishes the sales target for the upcoming year. And this revenue target will be the starting point for all the various other departmental units that support the revenue earning process of that company. So first thing we do is we establish the revenue budget, and then we have to make assumptions with respect to how much we plan to, have as ending inventory, just in case our revenue budget on a month-to-month basis is not 100% accurate. So we need to build in ending inventories and beginning inventories in our production budget. So revenue gets translated to the number of units produced, and that normally incorporates any inventory that we require. And the production budget is the one that triggers how much materials we need to buy, how much labor we need. And remember, these budgets are on a month-to-month basis. And so that we'll know which months that we need to hire extra workers, for example, and which months do we have a low level of activity, depends on the revenue budget to month. The materials is important because let's say we end up needing materials that are difficult or may have a supply limitation, then we're going to have to figure out ahead of time whether we need to engage with another vendor relationship to hopefully fulfill and make sure that we have enough materials in our to support the production budgeting cycle. Now, materials will also have a beginning and ending inventory requirements. Again, just in case that if our revenue is slightly off, then our production will be able to accommodate with perhaps building up some ending inventory. And of course, we will also need some materials inventory as well. Now, in terms of manufacturing overhead, there's always a requirement that we need to budget for that. And of course, that all feeds into the cash budget. So you'll see that when most companies, when they do a master budget, they usually start with revenue, then they budget for all other expenses so they can figure out what the budgeted operating profit is. And of course, this will eventually feed into the balance sheet by budgeting for cash and any remaining working capital that we need. And then, of course, once you have that, you can create a budgeted financial statement. So that's essentially a quick overview of the budgeting process that a typical organization would need. And we're going to take a look at this question next, Sears Manufacturing. So in this question, it's basically a company that has the following projected sales for the next 6 months. And you'll see that the products are, the sales price is $100. The variable expenses is $70. And the fixed cost is $1,500 per month. Now, it says the finished product requires 3 units So the finished goods requires 3 units of raw materials, and so that's direct materials, and each finished goods requires 10 hours of direct labor. Okay? The company tries to maintain ending inventory of finished goods. Okay? It says equal to the next 2 months of sales. So for January's ending inventory, we want 190, for example. Okay? It's important. Now, every one of these are relationships, and these relationships have been developed over time. So if you think about it, a lot of these rules are required in budgeting question because these are often the norm of this particular company. So in this company, they want to make sure that they have sufficient ending inventory for the next 2 months of sale, just in case these number of units sold are slightly off on a month-to-month basis. So they've got room to accommodate and not lose any customers. Now it says the ending inventory raw materials. So raw materials ending inventory, we're told, is equal to 1/2 of the current month's needs. So that's what that is, okay? So these are, again, budgeting rules for ending inventory. Now, the first part asks us to prepare a production budget for February, March, and April. That's the first part. So remember, these are the sales budget. So if you remember that original schematic diagram and budgeting, we start with revenue, and these are the revenue that's given to us. And now we need to build the production budget, which is the first part of the required. And then from the production budget, we're going to need to know how much materials we're going to need or require for February, March, and April. And we're also going to need to know how much direct labor that we need to require for February, March, and April. So this essentially depicts this whole entire cycle. We're only looking for this part of the cycle. We've got the revenue budget, we're asked to prepare the production budget, and then indirectly from that production budget, we need to prepare the materials and the direct labor budget. That's essentially the question for Sears. So let's start answering the question. So for production budget, so I like to use the column approach when I do budgeting. So I've got February, March, and April. So do the 3 columns. So I always start with the ending inventory. So this is called the desired ending inventory. Okay. And the desired ending inventory for February will be the sales, right? For March and April. So that 100 plus 80. And for March, it would be 80 plus 30. Okay? So that's where I'm getting my numbers from. So 180, 110, and 100. So these are 2 months of sales. I guess I put them in the next 2 months of sales is really what I'm trying to figure out. Okay? Now, the actual sales, we know that that was 90, 100, and 80. So this is how much I need. 270, 210, and 180. Now, how much beginning inventory do I have? So obviously, my ending is going to be my beginning inventory for the following month. And for February, it would be 190. Okay? 190 because February, right, would be January's ending, and that would be, again, the next 2 months would be 90 and 100. Okay? And that gives me the production requirements. This will be 80, 30, and 70. Okay? So this is how much I'm going to need to produce for each of the month. Okay. Now, part B says, let's prepare the direct materials budget. Again, I'm going to use the same 3 columns, February, March, and April. So, how much do I need to plan usage? Okay, remember I need current production times 3, because we're told that each unit requires 3 raw materials. So I take 80 times 3, isn't it? So 90, and this one is 210. I'm just going to use the red mark pen times 3. Okay. Desired ending inventory. Okay, and we know that we need 1/2 of current month's needs. So this would be 120. So 1/2 of this, 45, and 105. So this will be times 50%. This is how much I need. And beginning inventory, we know that this is 120. This is 45. And this one is 150. Okay? Now, how did I get 150? I get the January production requirements, which is 100 plus 90 plus 40 minus 40 and 90. All of that times 3 times 1/2 to give me 150. Okay? So that's how I got this one. So altogether, this is 210, 15, and 270. Now, for part C, direct labor budget. And what are we told? We're told it's 10 hours, right? 10 hours direct labor per unit. And so, what is the current production times 10 hours? Current production is 80. So for February, it's 80 times 10 is 800 hours. And for March, it's 30 times 10 is 300 hours. And for April, is 70 times 10 is 700 hours. So let me just highlight this. I'm just going to highlight the okay, so that's for February. So February, March, April. And this is for direct material. And this is for direct labor. Okay, thank you.